Welcome to the Deep Dive, your shortcut to being truly informed. Today we are plunging into the global real estate market for 2025. And look, it's not one single picture out there. It's really quite a divergent landscape, lots of unique opportunities, but also specific risks. Our mission, to take a deep dive into our sources, cut through the noise, and give you a clear view of the investment potential in four key cities: New York, London, Tokyo, and Mumbai.
Absolutely. And I think what's really crucial to grasp up front is that unlike some past cycles we've seen where things moved more in sync, this time we've got very distinct monetary policies from the major central banks: the Fed, Bank of England, Bank of Japan, Reserve Bank of India. And these policies, they're creating specific headwinds for some markets and tailwinds for others.
Different currents pushing in different directions.
Exactly. And you have to see this against the backdrop of, well, fairly modest global growth. The World Bank's talking maybe 2.3%, IMF around 3.3% plus ongoing trade tensions. It just hammers home the need for, a really nuanced city-by-city look, not some broad brush approach.
Okay, so let's unpack that. How are these specific central bank decisions actually shaping what's happening on the ground in, say, New York versus Tokyo?
Yeah, the link is pretty direct. Take the U.S. The Fed's sticking to its higher for longer idea, right? Rates over 4%. That translates directly into higher mortgage rates, maybe around 6.7%. That's a clear headwind for New York City. Makes buying much pricier.
Okay, so more expensive borrowing in NYC. What about London?
Well, London's different. The Bank of England is still wrestling with inflation, but the signs are pointing towards easing up a bit. Forecasts suggest rate cuts perhaps down to 3.75% by the end of 2025. That could give the London market a bit of a boost.
A potential stimulus then. And Japan, they just ended negative rates, didn't they?
They did, yeah. But even ending negative rates, their policy rate is now what? 0.5%. It's still incredibly accommodative, so you still have these historically super low borrowing costs in Tokyo. Massive difference.
Wow, okay. And India?
India's Reserve Bank is actually easing policy. The repo rate's down at 5.5%. That's a huge tailwind for Mumbai, really stoking domestic demand, especially when you factor in India's projected GDP growth over 6%. Pretty impressive.
That paints a really clear macro picture. Okay, let's dive into the cities. New York first, our sources call it the supply constraint apex. Why that label?
It fits perfectly. NYC's core issue is just a massive shortage of housing supply. Vacancy rates were incredibly low, maybe 2.83% across the whole metro area. But get this, in the Bronx, it's like 1%.
1%.
Yeah. And that shortage directly fuels record rents. We're talking a median possibly hitting $4,700 by mid-2025. That's up almost 7% in a year. But here's a key thing. The sales market is surprisingly resilient. Why? Partly because a record number, something like 69% of Manhattan deals, are all cash.
69% cash.
It tells you a lot about who's buying: high net worth individuals, less sensitive to interest rates, looking for stability. And keep an eye on office to resi conversions. That's a potential catalyst bringing some desperately needed supply online.
Fascinating. Okay, from that supply squeeze in New York, let's hop across the pond to London. Described as bifurcated market in transition. What's that mean?
It really means there are two Londons right now. You've got prime central London, I think Kensington, Mayfair. That area is still down maybe 10, 11% from its peak back in 2014, which, by the way, for a US dollar investor means potentially a 40% discount when you factor in the currency exchange.
40% cheaper in dollars. That's significant.
It is. But then you look at Greater London and it's seeing some modest growth. The overall sales market is a bit sluggish. Average discounts are around 9%. But the rental market, totally different story. Red hot. Again, it's chronic undersupply, pushing UK average rents up nearly 7%.
So tougher buyers, great for landlords.
Well, yes and no. The tax situation is complicated. Higher stamp duty, that 2% foreign buyer surcharge. It's pushing smaller individual landlords out. But that actually creates an opening for the bigger professional build-to-rent players. They see an opportunity there.
Interesting dynamic. Okay, let's switch gears again. Tokyo. Riding the wave of foreign capital, what's pulling the money in?
Tokyo's like a perfect storm for foreign investors right now, seriously. First, the yen is still persistently weak. That gives foreign buyers way more purchasing power. Combine that with those unique ultra-low financing costs we talked about, that 0.5% BOJ rate.
Right.
It creates this thing called a real estate carry trade. Basically, you borrow cheaply in yen to invest in Tokyo real estate that offers a better return. It's a powerful magnet for foreign money. And you see it in the numbers. Prices up over 8% year on year in the metro area, over 10% in central Tokyo itself.
Huge appreciation.
And the rental market is super tight, too. Rents up 8.4% annually, occupancy over 96%. The main risk, honestly, it's that its own success could backfire. If local affordability becomes too big an issue, you might see policy changes targeting foreign investment.
A potential backlash. Got it. Okay, final stop. Mumbai. The high-growth, high-demand engine. What's fueling that?
Mumbai's story is really about massive domestic wealth creation. India has, 185 billionaires now, and their wealth has shot up like 260% recently. That wealth is pouring into luxury housing. Premium homes now make up over 60% of the value of sales in Mumbai.
60%, wow.
Yeah, and you're seeing crazy price appreciation thing, for example, up 60% in just 5 years. Huge infrastructure projects like new metro lines, the new airport, they're all acting as catalysts. But there's a major affordability crisis for average people. The EMI to income ratio is like 48%.
Nearly half their income just on the mortgage payment.
Exactly. So the market's becoming very dependent on that narrow slice of very wealthy buyers. That makes it high growth, yes, but also, high risk.
Right. High growth, high risk profile. Okay, we've covered a lot of ground. Let's bring it all together. For you, the investor, looking at 2025, what's the bottom line?
Well, if we synthesize all this into a kind of ranking, always remembering the nuances, Tokyo looks like the clear leader for 2025. That unique mix of a weak currency, super cheap financing, and strong fundamentals is hard to beat right now. New York is probably a close second. It offers incredible stability and that reliable income growth from the housing crisis, even if capital appreciation isn't as explosive.
Okay, Tokyo, then New York.
Then London. It's a really strong contender if you're value-focused, especially with those prime central London discounts and the solid rental yields. And Mumbai. It definitely offers the highest potential for capital growth, fueled by that domestic wealth boom and infrastructure spend. But it also carries the most significant risk because of those extreme affordability issues and reliance on a thin segment of buyers.
So, a very clear hierarchy, but with important caveats for each.
Absolutely. Risk and reward tailored to each city.
Which leads us to the final thought for you listening. Given these very distinct risk-return profiles we've just unpacked for New York, London, Tokyo, and Mumbai, how might your specific investment goals, maybe you want maximum growth, maybe stable income is key, or perhaps long-term value is your game. How might those goals redefine which city actually offers the best opportunity for you in 2025? Something to think about as you weigh your options.